Welcome everybody to tonight's special presentation, Trade ETFs Smarter, Not Harder. Tonight we're diving into bullish and bearish ETF pairs, what they are, how they work, and how you can use them in your trading strategies. ETFs, or exchange traded funds, are baskets of securities that trade like stocks. Some ETFs move with the market, those are bullish, while others move against the market, those are bearish, allowing traders to profit in any market condition. Why is this important? Because whether the market is going up or down, there are always opportunities to trade. A well-balanced strategy using these ETFs can help you protect gains, hedge risks, and take advantage of market swings. By the end of this session, you'll have a clear understanding of how to incorporate these ETFs into your trading toolbox. Let's get started. First, let's define bullish and bearish ETFs. Bullish ETFs, also known as long ETFs, track an index, security, sector, or commodity. When the market rises, these ETFs gain value. For example, SPY tracks the S&P 500 and moves up as the index appreciates. These ETFs are useful when traders are confident in market growth, whether due to strong earnings, economic expansion, favorable government policies, things like that. Bearish ETFs, also called inverse ETFs, move in the opposite direction of the market. If the market drops, these ETFs go up. An example is SH, which allows traders to benefit when the S&P 500 declines, which it's done a lot lately. Bearish ETFs are particularly useful during downturns when protecting capital or profiting from bearish trends becomes essential. Some ETFs are leveraged, meaning they amplify the movement of the underlying index by 2 times or 3 times. Example is TQQQ, that's bullish. On the NASDAQ, SQQQ, that's bearish for the NASDAQ. These ETFs can offer bigger returns but come with higher risk due to daily rebalancing and volatility decay over time. Now let's look at some common ETF pairs that traders use. Just here's a quick breakdown. Each of these ETFs provide exposure to different market sectors. Bullish ETFs let you ride upward trends, while markets are strong, helping you capitalize on broad market strength or sector-specific rallies like oil or gold. Bearish ETFs allow you to profit when the market declines, giving you a way to hedge long positions that may still be in your portfolio or trade on negative market sentiment. If you're trading these, always consider liquidity and volume for smoother transactions. High liquidity means tighter spreads, easier entry and exits. You can use market orders when the spreads are tight, and less slippage in volatile markets. Now that you know the ETF pairs, we're going to get into the program in a bit. I'm going to show you the watch list that we've created for these different types of ETFs. How do you use them? Here are a few strategies. Hedging, number 1. If you own QQQ, for example, that's the bullish, non-leveraged ETF on the NASDAQ 100. But you anticipate maybe a short-term pullback. You can buy PSQ, which is the bearish counterpart to QQQ. It's the non-leveraged ETF. This can help offset losses. There are option strategies, more cost-effective, that you can learn to hedge against long positions. But if you don't know how to trade options, there are alternatives. This is particularly useful in uncertain markets, allowing you to stay invested while reducing downside exposure. You know, QQQs, they do pay a dividend. So if you don't sell it, you want to hold it for the dividend, there are ways you can offset losses. Momentum trading, number 2. In strong trends, buying TQQQ, which is the bullish NASDAQ ETF, or SQQQ in downtrending markets, allows you to capitalize on big moves. If the market is showing a clear direction, these leveraged ETFs can amplify gains in a short period, but timing is crucial. And then 3rd, mean reversion. If an ETF is overextended, traders may take the opposite position, expecting a price correction. For instance, if the S&P, SPY, has rallied too fast, you might take a position in SH, expecting a pullback to a moving average or support level. We'll take a look at an example in a moment. Before jumping into these ETFs, let's discuss the risks. Number 1, decay in leveraged ETFs. Leveraged ETFs reset daily, meaning their long-term returns may not perfectly match their expected performance or the performance of their benchmark index. This makes them less ideal for long-term holdings and more suited for short-term trades. For example, here's a quick test over the last 1 year, year over year. of the NASDAQ IXIC, the SPX, which is the S&P, and their non-leveraged and leveraged ETF counterparts. So SPX over the last year has gone up 3.5%. You could see the SPY, which is the non-leveraged S&P 500 ETF, bullish ETF, also went up close to that, 3.33%. But look at SPXL. This is the triple leveraged S&P 500 bullish ETF. It's actually down 5.5%. The NASDAQ IXIC up 1.68%. Triple Q up about the same, a little bit more. But its counterpart, the triple leveraged NASDAQ ETF T Triple Q, is down 17%. You would expect if the NASDAQ was up 1.5%, that the Triple Q, which is 3 times that, would be up about, almost 4.5%. Not the case. Over time, decay really erodes performance. So keep that in mind. They're for short-term trades, the triple leveraged ETFs specifically, not long-term investments. Tracking errors. Some inverse ETFs don't perfectly mirror their benchmark's movement. You factor in fees, rebalancing, market efficiencies. That can all lead to discrepancies in expected gains and losses. Number 3, market conditions. These ETFs work best in trending markets. In choppy or sideways conditions, frequent price fluctuations can erode gains and create losses from false breakouts or whipsaws. And then finally, liquidity and costs. You got to consider bid-ask spreads, expense ratios, tax implications, of course. Some ETFs carry higher fees that can eat into profits over time. So you got to make sure to factor in these costs before making any trade. Understanding these risks will help you use ETF pairs more effectively and avoid costly mistakes, ensuring your strategy is aligning with market conditions. Okay, so we have a foundation now, an understanding on the different types of ETFs that you can use. Let's get into the program and let me show you the watch list that we've created. All right, now here we are in the VectorVest program, and of course, our decision is always going to be based on what the market's doing, right? So whether we're bullish or bearish on the market will be determined by the color guard here, really, right? So color guard is mostly red. I think there's no denying that our overall market bias has to be bearish right now. BSR, even though it's at 0.09, well below 0.20, even the MTI below 0.60, we don't have a bullish bias. So the only other option you have right now is inverse ETFs. So I'm going to go into the viewers. I'm going to go into the ETFs folder. And here are 2 new ETFs watch lists, ETF pairs bearish and ETF pairs bullish. So let's, of course, start with the bearish list. Click on the bearish list. It automatically sorts the list like any watch list by VST. Now, you can see that we might as well be sorting by RT, right? Because with all ETFs, we always give a value of 1 to both RV and RS. So RT is really the indicator that you would focus on for analyzing ETFs. These are, of course, all high momentum ETFs. So a few strategies that we went through earlier: high momentum ETF trading, a mean reversion, hedging. These are, of course, all high momentum ETFs right now. However, one of the things we also talked about was make sure you're paying attention to volume and that make sure that there is liquidity. I wouldn't necessarily trade BERZ. It only trades 175,000 shares on average, or even HIBS, only 284,000 shares. Definitely would stay away from this one. WEBS. OILD only trades 141,000. And then you can scroll down the list. Absolutely stay away from this one and this one. So what I would do, you can either sort by average volume, and if you do that, of course, those are the most actively traded ETFs at the top of the list. You can then scroll over to the left and then cherry pick your way through this list. A lot of these still have really strong RTs. SPXS 1.84 RT, SQQQ, that's the triple leverage NASDAQ ETF 1.93. You can also sort by average volume times RT. So if I click on my sort button here, drop down my arrow, go average volume times RT. That will give us at the top of the list the ETFs with the best combination of average volume and RT. Let me close this down, give us a little bit more real estate. You have a lot of the similar names at the top. Okay. If you have to build average volume times RT, you can do that from Tools, go to Custom Field Builder, go to Fields, select average volume, multiply that times RT. Make sure it's valid. There we go, it's valid. Save the changes. It already exists, so it probably either exists in the program that I'm using here, or it's public to everyone. Okay? Now, let me graph them and put on just a couple of indicators here. So I'm going to put on RT, and we got volume at the bottom. Obviously, this one is trading very actively. Shares, if I right-click on volume, go to Add Moving Average, simple, add the 50-day moving average of volume on. This ETF here, SPXS, is trading above average. Of course, not today. It's still early, but last couple of days, last week or so, and really for the last couple of months, for the most part, this ETF is traded well above the average volume. We got RT on the bottom, so RT at 1.85 or 1.84, excuse me. This is a very high momentum, obviously, trade, right? Now, you'll analyze these ETFs just like you would an individual stock. I'll add moving averages to the chart. So if I want to know if SPXS is in an underlying uptrend, I'll put the 200-day moving average on. You could see the ETF's price just recently broke above the 200, came back down to retest it, and has exploded away from it. All right, so the underlying trend is up. I'll put the 50-day moving average on. That's your midterm moving average. Price is also above the 50-day moving average, so your midterm trend is up. I'll then put the 20-day moving average on, which is your short-term moving average. And of course, with price going parabolic here, it is absolutely in a very strong short-term uptrend as well. While there's no one market timing signal that you're going to follow necessarily when trading any ETF, what I would say is focus on the MTI. And the reason why, one of the reasons why we're bearish right now on the market is because the MTI, of course, is below 1. We're in a confirmed down call. We got that confirmed down call in December of last year. The MTI has been below 1 for the most part during that time. So again, while there's no one market timing signal, be bearish when the MTI is below 1. Be bullish when the MTI is above 1. If you keep that foundation in place and favor bullish ETFs, whether they be non-leveraged or leveraged ETFs when the MTI is above 1, and be bearish, favor inverse ETFs when the MTI is below 1, again, non-leveraged or leveraged if you choose, that's going to go a long way in helping you make money with these ETFs consistently. So I'll go through the charts here. These are all going to be high momentum trades. We talked about high momentum trading earlier with ETFs. I also said that mean reversion techniques can be applied as well. So for example here, if I have these moving averages on, the 50, the 200, and the 20, I may look for, because I think maybe that SPXS right now is a little overextended, a move or a reversion back to the 20-day moving average. That's your nice short-term moving average. So if you feel like SPXS is a little overextended here, it's gapped up for the last couple of days, you wait for a pullback or a reversion back to some of these moving averages. That is another technique. You can apply that with any of these ETFs. So here's SQQQ. Above all the major moving averages, the 200, the 50, the 20. You could see the 20 is upsloping, the 50 is upsloping. You still have the 200 that's downsloping, but this is in the early stages here, potentially of a new long-term uptrend. Price reversion back to the 20-day moving average might be a nice technique for you to deploy on some of these that truly have gone parabolic here. Here's NVDQ. This is a double leveraged inverse ETF on NVIDIA. So we have some single stock ETFs now that we can leverage. Price has just recently crossed above all major moving averages. Relative timing is at 1.90, so it's in a very, very strong uptrend, as is the case with all of these. Here's SOXS. We're living in unusual times now, of course, right? So the market is selling off severely. So we're going to see a lot of these parabolic moves with a lot of these ETFs. Here's a different one, though. Here's a double leverage ETF on Tesla. $4.31. RT is just crossed above 1, so it's not like it was here. But if we take a look at here, you might have thought that it was a little overextended here. You had RT at that time at 1.84. If you waited for a pullback back to the moving average, you were able maybe to take it there on March 14th, right? A nice kiss of that 20-day moving average. 20-day moving average is sloping upwards. So is the 50. Nice pullback. Instead of buying it when it was overextended, you waited for a reversion back to that 20-day moving average. I think that's a nice technique that you can focus on here with some of these ETFs if you do feel that they are overextended. TZEA, small cap, inverse ETF, again, above all the major moving averages, well overextended, RT strong, so sure it is a high momentum trade. And if the market continues to fall, there's no doubt that these will continue to skyrocket higher. So different ways to trade these ETFs. There's no one magic recipe. But again, if I go to graphs here, I'm going to go to a market timing graph, look at the last year, put on our MTI indicator, even pull us back a little bit further. Going back to what I said earlier, if you can be bullish, favor regular, either non-leveraged or leveraged bullish ETFs in this type of market environment, it's going to go a long way in growing your account, whether it's a longer term portfolio or even a swing trading portfolio. If you can favor bearish ETFs when the MTI is below 1, you'll be able to profit when the market falls, when a lot of other people are maybe sitting on the sidelines. Going back to the viewers there, if I open this up, we have the ETF pairs bullish watch list as well. And if we just keep the sorted VST, you could see some of these RTs. What do you expect to see at the top? Gold volatility index, right? The VIX and a lot of gold ETFs at the top with the 20-year and the 10-year in third and fourth place here. So to wrap up, today we covered the difference between bullish and bearish ETFs and how they work. We talked about some common ETF pairs for various market and sectors. Key strategies like hedging, momentum trading, pairs trading. We did mention hedging earlier. Again, if you're long the Qs still because it pays a dividend, PSQ might be a nice hedging mechanism if this market continues to fall. We've also talked about important risks to consider before trading these ETFs. These ETFs can be powerful tools, folks, but they require careful planning and execution. Whether you're looking to hedge risk, capitalize on trends both up and down, or trade market reversals, having a well thought out approach will set you up for success. Well, this concludes tonight's special presentation. Have a great weekend, everybody.